Welcome back to Ground Up Accounting. Now, in the last episode, we asked a deceptively simple question. What is a business? And once we stripped away the motivational slogans, the social media noise, and the endless parade of people telling you they cracked success at 23,
What?
we arrived at something far more useful. A business is an organization that uses resources to create value. And if we want to understand that organization properly, we need a way to record what it owns, what it owes, what it earns, and what it spends. That is where accounting begins. Today, Ground Up Coffee experiences its first financial event. No customers, no coffee, no sales, no expenses, just money. A single investment from the owner. And in that moment, something important happens. Ground Up Coffee stops being an idea and becomes a financial entity. Throughout this series, we will use the US dollar. Not because dollars are special, but because consistency matters. Whether you are operating in euros, pounds, krona, yen, or rupees, the accounting does not change. Only the currency symbols do. The rule remains identical. Assets remain assets, liabilities remain liabilities, capital remains capital, etc. Now, before we record anything, we must define time. For Ground Up Coffee, the financial year will run from the 1st of January to the 31st of December. Now, every transaction we record exists inside this time frame. Now, at the end of each year, we stop. We measure performance, we reset, then we begin again. Without this, profit becomes meaningless, because profit without time is just guesswork. The financial year is not the same as the tax year. The financial year asks, how did the business actually perform? The tax year asks, how much does the government want from us? They are related, but not identical. We will deal with tax later. For now, we focus on financial accounting. Accounting is split into two disciplines. Financial accounting, which records what has already happened. Now, this produces reports like the balance sheet, the profit and loss statement or income statement, and other financial reports. It looks backwards and it answers, what did the business do? Management accounting, however, helps decision making. It produces reports like budgets, forecasts, and cost analysis. It looks forward and it answers questions like, what should the business do next? Think of financial accounting as the scoreboard and management accounting as the coach. Now, this series is about the scoreboard. This series is about financial accounting. We will come back to management accounting at a much later date. In fact, it'll be a whole series on that. Before we record anything, we need structure. That structure is called the chart of accounts. Think of it as the map of the business. Every transaction must be placed somewhere on this map. But we are not going to build a full map yet. We're going to build it the way real businesses do, slowly, one event at a time. At this stage, Ground Up Coffee has only one transaction in its history. So our chart of accounts is extremely simple. In the assets, we have bank, and in capital, we have the owner's capital. As you can see, that's it. Nothing else exists yet, because nothing else has happened. Now, most people overcomplicate this, so let's simplify it. Now, I want you to imagine a T account. So on this T account, we have the debit side and we have the credit side. On the debit side, we find assets and expenses. And on the credit side, we'll always find liabilities, income, and capital. Now, just try and memorize this as we work through the series. What is an asset? Well, an asset is things like equipment, bank, assets. So you'll always find them on the debit side of your accounts. What is an expense? Things like insurance, rent, wages. You'll always find that on the debit side of your accounts. Liabilities, things like, tax or creditors, bank loans. You'll always find these under liabilities on the credit side. Income, things like sales from our sales of coffee, income. And capital, what we're just looking at now, owner's capital or equity in the business. Now, a simple memory rule. Think of it as AE left, or assets and expenses on the left. And LIC right, or liabilities, income, and capital on the right. Liabilities, income, capital. Think AE left, LIC right. Whenever you see a transaction, ask, what type of account is this? For example, insurance. What type of account is that? Well, we know insurance is an expense. So we know we'll find it on the debit side of our accounts. Something along these lines. Once you know that, you know the direction. Now, assets increase on the debit side. Expenses increase on the debit side. Liabilities increase on the credit side. Income increases on the credit side. And capital increases on the credit side. This is the entire system. Everything else is detail. We will explore this properly later, but we introduce it now. Now, if the business buys a coffee machine, the machine is an asset. Over time, though, it loses value. Now, that reduction is called depreciation. It does not mean the machine disappears. It means accounting recognizes it's wearing out. A simple idea. Assets decay over time, and accounting records that decay. Now, the chart of accounts feeds directly into reports. So our balance sheet will contain assets, liabilities, and capital. And our profit and loss, or our income statement, will contain income and expenses. That is the entire financial system. Now, Ground Up Coffee receives its first investment. The amount is $50,000. Now, this is not income. No sales have occurred. No coffee has been sold. This is capital, an investment by the owner. Now, if you can remember back to episode 1, we talked about the accounting equation, how assets will always equal liabilities plus capital. So in this transaction, the bank or the asset and the owner's equity, both sides balance, both sides remain balanced. Which, if we look at the equation, assets equals liabilities but capital, well, our assets are 50,000, which we could think of as the money in our bank, which equals our liability, which is 0 at the moment, we don't have any, plus the capital, the money we've just put into the business, 50,000. So there, assets equals liabilities plus capital, everything is in balance. So let's look at the journal entry and then look a little bit at how we record this in our accounting system, our accounting software. So here's the journal. This is what we're going to set up. So think of this as, think of our T accounts. So we have the account, which is the bank, and the owner's capital. Now we know bank is an asset, we know owner's capital is equity. So we are going to, as bank is an asset, we know it's a debit of $50,000. And because the owner's capital is equity, that is going to be that's going to end up on the credit side of this journal, $50,000. And we can see that now balancing out. Before we enter into the software, just one important idea. Now, people often ask, should I learn Sage? Should I learn QuickBooks? Should I learn Xero? You know, that's like asking, should I learn Mercedes? Should I learn BMW? Should I learn Volvo? Should I learn Toyota? You don't learn Mercedes, BMW, Toyota, and so on. You learn how to drive. Once you can drive, you can use any car. Accounting software works exactly the same way. Whether it's Sage, QuickBooks, Xero, GNU Cash, which I will be using in this series, they're all just tools. They are all trying to do the same thing. Double entry bookkeeping. The software is the dashboard. Accounting is the engine. If you understand double entry bookkeeping, that's all you need to know to use any of these accounting software programs. Much like once you learn how to drive, you can drive any car you please. Now we record the transaction. So I'm going to open GNU Cash, my accounting program. I'm going to go to the bank account and I'm going to create a new transaction. Now in the description, I'm going to write owner capital injection. And I'm going to transfer from the owner capital an amount of $50,000 to the bank. I'm going to save that, then click show splits. Now we see the truth of accounting. This is the double entry. This is the T account. This is the debit, which is the bank, and the credit, which is the owner's equity. We can see the two sides are balanced, one transaction. So now let's post this to the accounts. So let's have a look at the chart of accounts. So we have two accounts set up so far. We have bank and we have owner's capital. Let's look at the balance sheet. We can see that under assets, we have bank to the amount of $50,000. And if we look at liabilities, we have none. We haven't incurred any liabilities yet. And on the capital end of it, we can see the owner's capital at $50,000. So let's just check the equation. $50,000 assets equals $0 liabilities plus $50,000 capital or equity. So that all works out fine. And we just want to check the profit and loss account. Well, nothing has happened yet. There's been no sales, no expenses, so there's nothing to record there yet. And on the trial balance, we can see on our trial balance, our bank account on the debit side, $50,000, and our owner capital, $50,000 on the credit side. Just to go back to the journal for the capital, owner's capital, we're going to date it the 1st of the 1st, 2026. This is the year that I'm recording this in, so we'll stick within this year just to make it more clear. So the 1st of the 1st, 26 is the date that we're going to use in this example. So now today we opened the books. We defined the financial year. We introduced the chart of accounts. We explained debits and credits. We recorded the first transaction in ground up coffee. And we built the foundation of the entire series. In the next episode, money will begin leaving the business. We will meet suppliers. We will introduce invoices. We will introduce credit. We will buy inventory or stock and equipment. And ground up coffee will begin to feel like a real business. Because so far we haven't run a coffee shop. We've only opened a bank account. The real business starts next time.